at any point in your career. You could just be starting out. You could be 5 years from retirement. You could be 5 years into retirement. You're somewhere right now. How do I make an impact in what I'm doing within my business? How do I get the maximum value if my goal is to sell that business?
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
I want to talk about today how to expand, or more importantly, how to exponentially grow the value of your business. And this is something that when you think about your business, if you're a business owner, and I want you to really get into this position, like this is going to appeal to business owners, today's conversation, people that want to become business owners, and also people that are interested in selling their businesses, but a lot of the principles will actually apply back to your personal return if you're working for a business, right? Because if you work for a business, one of the things that you want to do is you actually want to make more money from that business that you're working inside of. So if you understand these principles that I'm going to be going through today, you can actually add a lot of value to the company that you work for if you can apply these things. But it's important to understand you could be at any point in your career. You could just be starting out. You could be 5 years from retirement. You could be 5 years into retirement. You're somewhere right now. And one of the most important things in that process is really understanding, how do I make an impact in what I'm doing within my business? Okay. How do I get the maximum value if my goal is to sell that business? And we all know the stats, right? The majority of businesses that make it over $1 million in revenue are about 5% of all businesses ever started. Those that make it over 10 million is less than 1%. And the businesses that actually get listed, according to the Google search, okay, that get listed for sale, somewhere between 30 and 40% of those businesses actually sell. And when you dig into those stats, most of those businesses sell for far less than their value. They sell for book value in a lot of cases, right? They get discounted, and there's all these wonderful tax structures that we were talking about as far as the C Corp and S Corp and all these other things, as far as the way you want to sell things, and there's tax benefits. We're not talking about that today, right? What we're going to be talking about is, if you think about what's happening, where are you right now in your business? Let's say you're a business owner. You might have 2 or 3 partners. You might have some junior partners that you want to buy equity in. And, a lot of people that I talk to, unfortunately, that we meet along the way, are kind of tired. And they're like, it's good enough. And my business is good. And if I could just do this. And it's like, you got tired of doing it because you've lost the focus. And now the company is not as profitable as it could be or should be. And now you're going to let somebody come into the business for a lesser value than what it's really worth, because we kind of lost our focus, we lost our steam, we lost what we want to do, right? So one of the most important parts in any financial planning process, right? We have the Wealth Curve Blueprint. We have one that's specifically designed for entrepreneur, people that own their businesses, right? And it focuses on, we have this thing called the Blueprint, which everybody has a Wealth Curve Blueprint. And that Wealth Curve Blueprint is an income statement. It's a savings rate, a tax rate, all the expenses and the insurance costs, current assets, current liabilities, future goals and obligations and tax liabilities. On the bottom is your defense, your life insurance, your disability insurance, your long-term care, your Social Security, your guaranteed income, pensions, etc. The umbrella protection, the liability protection around that, and really great strategic and trust. As a business owner, you actually have two. And the two play together unbelievably beautiful. And I've seen this happen in my 34 years, is that people get to a point where the business has produced so much income and they've accumulated a lot of money. In a lot of cases, they let that business go for less than fair market because they've become tired and they just shut it down. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. And to me, the whole reason to own a business is to keep growing it to a point where when you sell it, you're getting full value for it, because why did you put in 30, 40 years to get to this point and then sell it for a fraction of its value, or just close it? Okay. So I want to dig into this today, and I want to dig into, we're going to come back through this and circle through a lot of different conversations, but the ultimate goal is, how do I maximize the value of the current business, the current profitability? And how do I get it ready for either acquisition or being, moved from one generation to the next in a strategic manner that the one generation gets full value, the second generation gets the ability to run that business and grow it to the next level? Those are different nuances. Or I'm just going to simply sell it, or I'm going to take it public, or I'm going to get tucked in under a roll-up that's going to add value. And I might be, I add value to that other business. And by putting 2 or 3 or 4 businesses together, the multiples get greater, right? So I want you to think for a second, and your numbers are your numbers, where you are, your industry, your revenue, the way you get revenue. It's unique and it's different to your business, right? But the idea is, let's say that you have a business that it's a pass-through entity. Let's say it's an S corporation. 1120S is the tax return that you file, okay? I got to tell you, way too many people, when I ask them what their entity is, they have a gloss, a glaze, a haze over their face. They're not exactly sure. And if you don't know what your entity is, you probably don't know really what's going on your balance sheet, on your profit and loss statement, on your tax return. And unfortunately, that leads to extra taxes being paid, missed opportunities, loss of value, poor performing EBITDA, the things that are really, really, really important to maximizing that value of the business. I want you to be empowered by this. This conversation today, you could literally take this conversation, do the transcript, and have a lot of tools that are going to be very, very valuable to you, okay? That's what we want. We want to give you as much value as we possibly can along the way. And we want to create this environment that basically says, if I'm 40, I'm 35, I'm 40, I'm 50, I'm 60, and I'm getting ready to sell my business, I'm in different elements, or I want to sell my business in 4 to 5 years, or I want to start a business, I need to make sure that I take the right steps, right? So just pretend for a moment that you have a business that, S corporation, you pay yourself a base salary of $150,000 because somebody said that makes sense, okay? And you actually take an S corporation distribution for $300,000. So you're making about $450,000, right? And that business, based upon whatever business it is, when you look at your SIC code, okay, you look at what it is, all those businesses actually have a multiple that they trade for. And that multiple that they trade for is based on the industry. And there are stars in that industry, and there are mediocre companies, and there are poor performing companies. And the question is, where are you? Where do you fit in? Is your company a high performing company? Do you have all the right things happening in your business to make that company more valuable? But let's just say, for shits and giggles, I like that term sometimes, okay? But let's just say, for reality right now, that your business has a 5x multiple on it. Could be 10, could be 15, depending on your business. But let's just say 5. So in order for somebody to come in and buy that business, they're looking at the EBITDA and they're saying, it makes $300,000, you pay yourself $150,000. And it's sort of like they're looking at your tax return and they're negotiating with you. And they basically say, okay, we're going to give you $2 million for that business. And that sounds like a ton of money, right? Now, depending on what you've been doing for the last 20 years, how much you've accumulated, et cetera, it might be okay. But a lot of people I've encountered over my 34 years of doing this, they've invested everything back into the business. Now they sell it for this 1.5 or 2, let's say for $2 million. They net 1.5 million afterwards. And they go to the investment advisor and say, I need to generate income from this. I'm making $450 the day before I sell the business. Now I sold the business. I'm free of the business. And now I'm going to have $75,000, $80,000 a year in income plus Social Security. So maybe I get myself up to 110. That's a lifestyle shift that many people are not prepared for. And many people are counting on the sale of the business to be their retirement vehicle. And we already know the stats on the sale. So what I want to kind of think about is that's mediocre. It's not what you wanted. You know, how do we take this business and how do we make it more valuable? So I want you to start thinking about something, right? In my industry, the way I think about it, which I'm in financial services, we have a registered investment advisory firm, we have an insurance division, we have a planning division, we have a whole series of companies that are complementary to each other, okay? And those companies come together to provide what we believe really good value for the clients, okay? Now, when you have a business, a long-term mentor of mine by the name of Nick Murray, used to go to his workshops all the time. He was focused on the financial services industry. You may not have ever heard of him, but he's written some great books. He's got a newsletter, pretty cool guy. He had a concept called QQP. And it was the success of you in your business comes down to the quality of your work, Q, number one, the quantity of people that you share it with, and how people perceive what you do. And his position was this: most people focus on how people perceive what they do. And the essence of the conversation is you have no control over how somebody's going to perceive you. You could be listening to this podcast and say, I perceive you as a moron, okay? Because you don't like the inflection of my voice, okay? You don't like my suit. You don't like whatever it is, okay? But the reality is that has nothing to do with your success if I master quality and quantity, okay? So if I have a really great service that I do, high quality, and my staff is high quality, and my training is high quality, and my customer service is high quality, and my salespeople are the best of the best, and the people that I have that support the process are the best of the best, and all of my clients call me first when anything is happening, then I have great quality. I believe quality is a never-ending cycle of improvement. Just because we did something one way doesn't mean that we need to repeat it over and over again if we can improve upon the quality of our work. And I would think that in most businesses, there's a whole series of things that are not the highest quality that they can be, and you know it, right? And you actually know that. The second methodology is my father used to talk about this, but it was the quantity of people that you share it with. And my father would say, we had this great idea, but it's like shouting down a well. Nobody's down at the bottom, maybe one person waiting for you. And that one person you saved, but there's nobody else down there. So you have to share what you do with as many people that can benefit from what you do on an ongoing basis, okay? So you start to think about your business for a second, your products, your teams, your support structure, your communication, everything that you do, what is that quality? And can I make that quality a better outcome? And then can I share it with more people? If I focus on the quality and the quantity, the business is going to get better. Okay. But I want to get to the heart of this thing. If you're following this on the YouTube channel, there's some screen shares happening. And I'm actually right now shifting from our business process over to an 1120S tax return. Okay. And here's what we're going to do. We're going to dive into, I don't want you to visualize this for a second, or if you're not driving or listening to this on a walk, sit down, pull out your tax return, pull out your latest profit and loss, pull out something and start to go through this. So line 1 of your tax return is gross receipts, gross sales. So I want you to pretend for a moment that your business grosses $1 million. Congratulations, you're in the top 5% of all businesses, okay? But your business grosses $1 million. And think about how your business makes that gross $1 million. Is it a service? Is it a widget? Is it a commission? Is it a revenue source? Is it an affiliate marketing? There's multiple ways that you're going to do business, right? But I want you to think about, how many clients do you have? What's your average price sale, right? And that equals the $1 million. And let's assume for a second, everything on the rest of that profit and loss, that tax return, stays exactly the same for a second. And what I want you to get your shifting of your thoughts are, business growth is not a linear movement. Meaning, hey, I've been doing this for 20 years and we've been getting a 5 to 6% solid growth in the business every year. And we've been, steadily increasing. And my belief is that business growth is exponential. It's a nonlinear transaction. Okay. So that if I dig under the hood, and these are examples of stuff that I've seen during the time frame, and I was sitting with a really great client a few years ago, and I just simply asked them a question about their pricing structure. And they were consistently, getting really, really nice growth because they had a strong attraction marketing. They were bringing in a lot of clients, right? And their revenue was hitting a really nice point, and they were doing well. But I said, tell me about your pricing structure. And we had a long conversation about it, 10 minutes. I'm just kidding, but it was a long conversation. And what I discovered in the conversation is they had been hesitant on raising their prices. They hadn't increased their pricing in 5 years. But meanwhile, everything else in their P&L below it, right? All the expenses were going up on them. So if they weren't getting an increase of sales, the increase of sales was masking the underlying problem that everything was going up in their expenses. So we said, why don't we try a phased in? We'll do something in May. We'll do a 2.5% increase, and then we'll do another 2.5% increase in September. And they were very nervous. They thought they would get drop off. They thought they would get fallout. They thought they would not have clients. And they ended up with a 5% increase in their pricing, which was an exponential number. But think about this for 1 second. 5% on $1 million is $50,000. If everything else is the same, what happens to that $50,000? It drops to the bottom line. And if the bottom line was $300,000, now it's $350,000. What kind of exponential increase is that in your bottom line profit from one small move? And this is why this is a nonlinear conversation, okay? If the business was worth 5x, that extra 50K is now worth another 250. So that business, instead of being worth 2 million, might be worth 2,250,000. It gets to the next level is that actually might push you to an expanded EBITDA calculation, a multiple. You might go to a 7x because now you're more valuable. I don't know that, but do you understand the value of just that one move? Now, in your pricing, you look at, okay, so I can change my prices. And then the next question is, how often do your clients buy? What's the frequency at which they purchase? And how long do they keep repurchasing for? And there was a long conversation with different clients at different time frames, at different types of products and services. But the reality was they were putting a gap in their fulfillment, meaning people would buy a 6-month supply and there was no auto repurchase. And they'd have to get their salespeople back on the phone to get people to resell. Expensive, time-consuming, etc. Dropped in an auto repurchase strategy, which everybody bought twice now during the year. And they got a little bit of fallout, but everybody else still bought twice. That was exponential. That combination of the frequency was off the charts. And then we said, let's talk about how many new clients do you get a year? What's your goal? And this is where I want you to step back for a second. What do you really want for your business? What are your true goals? What are you not doing to not hit your goals in your business? I have goals in my business. I've gone through a lot of things in my 34-year career, and there are goals that you have that you write down, and you're like, okay, those are my goals. But you're not doing any of the actions to get you to those goals. You have to ask yourself, why? Are you doing the things that are going to take you where you want to go? Or are you doing a mediocre job at your own goals, right? Do you believe that your company has the quality and they can share it with the right amount of people, right? Do you believe that your team can actually fulfill what it is? What is preventing you from turning on bigger sales? Like, is your marketing, are the dollars that you're spending on marketing in that $1 million business, let's say you're spending $50,000 a year on marketing, 5% of your gross budget, and you're getting a really good return on that money. Like, it's actually really working. Every time you spend that, whatever that frequency of that 50,000 that you're spending to get the marketing, you do it one more time. Dean Jackson, one of the great marketing guys, said it's like good marketing is like a Coke machine. Every time you put $1 into the machine, you get a return. All right. So how many times do I want a Coke? Well, as many times as I want that, right? So that marketing, if I increase the frequency of the marketing or the quality of the marketing, sometimes really bad marketing works really, really well. It just attracts the right amount of people, right? But if I can, let's say that to get to the $1 million, I had 1,000 clients coming in every single year and they were buying and buying and buying. And I could increase that by 10%. That now is going to raise my prices, raise my revenue, another exponential growth number, which if, it's going to increase my cost of goods, it might increase some staff, but a high percentage of that is going to drop to the bottom line. So now you're getting this exponential run. And then a lot of people, we look at what they're doing and they provide one or two services or products, and there's like a complementary service and or product that can be bolted on to increase your sales. Let's say your people, you're sitting here looking at this arm, and we were looking at this arm. We didn't like this arm because it falls over, and we need a weight bag to go on it, okay, to keep it from falling over. But we bought the weight bag from a different company. it's quality might be a little off, right? On the product. I'm just joking, right? But the reality is, sell me the weights also. Because with a really good stand comes a really good weight bag because you don't know who's going to knock into it and you want to take it over. What did I just do to my bottom line? It's pretty interesting, right? So now dig into the cost of goods. And what was interesting is I'm using a couple of different clients. Cost of goods for every business is going to be different, right? If you're a value-added reseller and you basically sell a product and for somebody else and for every dollar that you bring in, you got to give them 50 cents in the cost of goods, or a supplement or a vitamin or a product manufacturing or whatever that you're selling has a layer of cost of goods. And you have to look at, what are the elements of that? If you're an interior designer, there's elements of cost of goods. Like, how do you purchase your products? Do you get discounts? Do you get volume discounts? Do you have really good payment terms? Do you get paid first, or you have to lay out the money first and then get paid? If you understand how those things are going on, let's say that the cost of goods in this business, this $1 million business, is $200,000. So $800 is now running the rest of that business. If I can improve my pricing and get discounts, or buy from a different vendor, or buy from a different supplier, or buy from a different manufacturer, and keep the same level of quality, and I save 10%, $20,000. Seems nominal, right? That 20 now goes to the bottom line. It goes to the bottom line. Another exponential jump. That 20 is now worth another 5. The business is now worth another 100,000. And my profitability has now gone from 300 to 350 to 370. That's a massive increase. So when I start to look at these things, any good business has what I call an R concept, ARRR. Attraction, retention, retain. Well, retention and retain are the same thing. Okay, so attraction, retention, repeat, and referral. A successful business is going to acquire its customers by referral and attraction marketing. Both of those things have to be optimized. You have to give people the opportunity to refer you. You have to be doing great quality. You have to have a great service, and that your marketing to be super successful, people should be loving what you're doing, right? Once you get a client, the lifetime value of a client is exponential. Like, can you retain now that client? Now, in a lot of business, it's a one-time service, right? It's a one-time service. So, if you're a wedding photographer, you may not get, that person's not getting married, hopefully not more than one time, right? But they have a lot of friends that are going to get married. If they have the best video and the best photography, you're going to get referred. And that venue is going to refer you because they love the photos of their venue in there, right? It's like, oh, wow, those were the best social media posts that we had. So that lifetime retention of a client, the repeat business, the frequency in which they're buying from you, or they have a new opportunity and they want to come in, they have a new division, they have something new. There's that whole element of how you're mixing those 4 elements with the quality, with the quantity, and the perception, right? If you have enough quality in what you do, there will be enough people that perceive you as wonderful. And the more people you share it with, the more people that are going to perceive what you do as fabulous. And the idea is to attract as many of those people as you possibly can, right? That's going to make your business much more valuable. So as we go through this, line 1 on the 1120 is the gross receipts. Line 2 is cost of goods. And then you get to this, you start looking at compensation of officers, how you pay yourself. We encounter a lot of people that pay themselves way too much money, which makes their profit look low, which makes their business less valuable. And when you do that, you actually pay yourself, you pay a lot more taxes. So you make your business less valuable by paying yourself wrong, and you pay more taxes. I believe in opportunity cost. if I pay $10,000 of unnecessary taxes through poor strategy, not only did I lose the 10,000, I love the government. The government's fantastic. We have the United States. We have the greatest, country in the entire world, right? But I'm only entitled to give them their fair share. And if I pay them more, that 10,000 not only is the 10,000 gone and in something that I may or may not like, but now the future value of what that 10,000 can be worth. What's the compounding effect of that over a 25, 30-year business just by having poor tax strategy? And what I'm talking about is unnecessary Medicare tax, unnecessary self-employment tax, unnecessary loss of qualified business income deduction. Remember, we talked about that a few episodes ago. Not taking advantage of the state level pass-through entity tax where a corporation can pay its state level taxes on the pass-through entity. In New Jersey, they call it the BAIT tax, right? BAIT. So it basically allows you to pay your New Jersey personal income tax through your corporation and take a deduction for it rather than doing it afterwards. And if you're all salary, it's all coming through withholding. So you're actually paying way more taxes than you have to. And with the sunset of the tax law, the TCJA, Tax Cuts and Job Act of 2017, which is automatically going to rescind itself and, go back, revert back. It'll sunset in 2025. So in 26, we go back to the 2016 tax law under the Obama tax law. We go from a 37% to a 39.6. We lose the 20% qualified business income deduction. We lose a lot of things. We also gain a lot of things. So we got to think which one's better. Most people that I see, business owners specifically, the tax is substantially greater after the sunset of the BAIT. So we have to get prepared for that today, not the year in which it sunsets, right? So I'm in this concept. I'm going through this. I'm looking at how I pay my staff. Is everybody on the staff optimal, right? Is everybody performing at the right level? You may have people that you're paying a lot of money to that are not performing. That has an opportunity cost on it. You may have somebody that's really fantastic that could help you grow sales, but they don't have enough leads coming in, so they can't help you grow sales. And if they understood that, if they could get more leads, they'd sell more stuff. But the way your marketing's working, it's not yielding, right? Like, you got to really think through all these elements of what you're doing. Are you taking full advantage of all of the depreciation allowances that are available to your business? If you have, let's say you rent your business, you rent your office space, and you're spending $6,000 a month to rent your office space, your warehouse, your whatever it is, your Airbnb where you're working remotely from, whatever it is, right? You're spending all that money. At the end of your 20-year career, how much is the rent going to be worth that you paid? Zero. So let's say I buy a piece of property to house my business and it costs me $8,000. At the end of the 20-year career, what's the dirt worth? Heck of a lot more than the rent was worth, right? So what I see people doing is they don't purchase one of the most valuable assets, which is the real estate. You start to think about it, and it's like a lot of people that have their business in their own building aren't maximizing the rent structure. They're not paying themselves proper rent. So when they sell their business, you've been paying $10,000 a month in rent, but technically it could have been rented for 18 or 19. So when you sell your business, your new buyer is saying, we'll continue the $10,000 a month. You just effed yourself. And the business is not as value. If you can show strong market value, strong this, that money that's getting cycled out of your business, getting thrown into your landlord's pocket is not adding any value. What we want to do is I want to add value. I get up every day and I come to work. Not every day. I take some time off, right? But the reality is when I'm here, I want to make sure that every dollar that we're getting, we're maximizing it. Our expenses on the other side are being maximized. And we're adding as much value from the flow that's going out. We're recapturing as much of the flow that's going out. And what I find, there's so much money leaking out of a business and a personal wealth plan. Like if you just focused on, you've all seen the leaky boat conversations, right? I'm pouring a ton of money and water's flowing into the boat. But what's happening is it's leaking all out, or the leaky bucket syndrome is really the better. You want a leaky boat, or you don't want a leaky boat, but you don't want a leaky bucket. If you plug the leaks, you get my visual, right? If I'm pouring water revenue into a plan and I'm saving money and there's taxes and transaction costs and leaks coming out that way versus, redundancies and not paying the right people and not having good marketing and I got mediocre things going out, there's money leaking all over the place. If you just focused on plugging the leaks out of your business, how much more money would you make? Like most people are focused 100% on the rate of return on their money. And let's say that $450,000 guy, he's saving $50,000. He's worried about how's that $50,000 performing. But in the two boats, the personal boat and the business boat, there's 50, 60,000 leaking out. You find where the leaks are and you bring that money back over. You just doubled the amount of money that's going into savings. Then focus on the rate of return. Now you got 100K. Who's going to be more successful? The guy who saves 100K or 50K? Depends on where he puts it too, right? But there's a whole other conversation. Let's assume you put it in the best place. So I want you to get really strategic, but it comes back to what do you really want? Most people that I talk to, when I ask them, what do they want? I get, I don't want this and I don't want this and I'm tired of this and I'm tired of that. And then I'm like, what do you really want? That you're telling me what you don't want. But what do you want? You're focusing on what you don't want, you will get what you don't want. If you focus on what you want, you will actually get what you want. If I want to make my business more profitable, I need to get into the weeds. I need to understand where the leaks are, right? So I start going through this thing and I start looking at it and I'm saying, you're missing tax deductions, you're missing depreciation. Like how many people buy a rental property and they don't do a cost segregation analysis? So they get stuck with, straight line depreciation as opposed to, hey, the roof has a certain amount of life left in it. The parking lot has a certain amount of life into it. The siding has a certain amount of life. So instead of having a 27.5-year depreciation schedule, I might be able to bring that down to 15, 18 years overall, effectively. That depreciation is a funny money. It's not real, right? It's not a real expense, but the government says in my business, in my rent that I'm now paying, if I make $100,000 and I have depreciation of $20,000, I pay tax on 80 less qualified business income. But if I could find $40,000 of depreciation through cost segregation, I'm now paying tax on 60. Do you want to pay tax on 60 or 80? Would you rather? That's a fun game, right? Would you rather pay tax on 80 or would you rather pay tax on 60? Which one? So leaky boats, right? Now, line 17 and 18, employee benefit programs, pensions, 401k plans. Are you maximizing the contribution to yourself, or are they an employee maximization plan? Most that we encounter are maximizing the employee contribution, not the owner. And we need these programs to attract and retain really good quality people, but we want to get maximum value out of the benefits and the structure in which we're actually doing, okay? So you need to be thinking about, is the money that I'm putting towards employee benefit programs, health insurance, disability insurance, life insurance, 401k match, some kind of profit sharing plan, set plan, simple plan, whatever kind of retirement plan that you're doing, is it efficient? Is the best use for you, your business owner? Is it maximizing the value to you and the people that you want to maximize the value to? Are you getting full advantage of that? Most people don't. Most people, it's not optimized. It's not right. We did something with similar client that we were talking about earlier, found out they were pension contributions for the staff of about 50 was about, I don't know, about 170, 180,000. And they were ending up with 40. And nobody really valued it. Swapped it, reduced the contribution, got literally a much higher percentage going to them, closer to 60 or 70%. And the employees got a lot more value out of it. Win-win. You got to look at what's going on, okay? My favorite line on your 1120S is line 20, and it's other. And then you see there's a spreadsheet in the back of there's a schedule in the back of your return that lists a whole bunch of other really crazy expenses. And I got to tell you, nobody knows what's going on in those expenses. Those are the things that don't fall into the other categories. But again, if I go through this and I look at this and say, top line revenue, couple different metrics of how I can tweak it to improve it, that falls to the bottom line. If I can modify the way my cost of goods are, improve the quality, improve the cost of the quality of goods, improve the way I pay myself, improve the performance of my employees, my training, modify my depreciation expenses, maybe turn my rent into a building payment structure that you own that building. We were literally, a couple of years ago, we were working with a client and they had an option. They owned warehouse, they rented the warehouse next. They had an option to buy the warehouse. Rates were right. And I said, well, when are we going to do this? And I said, we don't have the money to actually do it. And I said, sure you do. And they're like, nah, we don't have it. And I'm like, well, you got the wrong people you're talking to, right? So we basically, make a long story short, 6 years ago, we took the option on that building and there was no money out of pocket. And to the acquisition cost was actually the same amount of rent that they were paying. And then warehouse space went up exponentially. If they didn't own that building, they would have paid a lot more money for it. So my point is, these are all things that I can't promise any of this is going to happen to you in your plan, because you might have the most optimal plan ever, right? You might. There's no guarantees on anything that I'm talking about, but this is a methodical, strategic way of thinking about your business. And if you think about your business, and I go through and I tweak my sales by 5%, reduce my cost of goods by 5%, modify the way I pay myself, make it more attractive and less tax burdensome. That's money to the bottom line. Change that depreciation. So instead of 300, 350 showing to the bottom line, I'm only showing 250, but I'm still getting the 350. Okay. Change the rent, change the employee benefit plans to maximize that. Go into that line 20 where all those 15 or 20 different expenses are. Make sure you're taking advantage of everything. That business is now going to make a lot more money. It's going to be a lot more enjoyable because it makes a lot more money, and it's now worth exponentially more than it was, because if you have a high performing business, your business is worth more. And if you can, let's say that all those little moves took your profit from 300 to 600. Couldn't you hire somebody to now run that business and take off all the crap that you hate doing and actually improve? Now maybe you're the sales guy who part-time sells because you got all business operation shit that's pulling you down. You just free up 30 hours a week for you to now focus on your clients and building those relationships and getting those largest checks and doing the things that you want to do. What is that? What is the price of freedom worth? If I could have somebody come in and run my business effectively and efficiently, and I could focus on what I want, I can increase my free time, I can increase my sales, I can increase my income, net, things are a hell of a lot better. And that's some of the stuff that is really, really, really important when you start to think about how you're going to optimize this value. So I want you to think for a second, do I want to do what I'm doing right now and continue repeating that? Or do I want to look at my business in a fresh way and figure out what are the optics, what are the measurements, what are the key performance indicators that I can tweak in my business to optimize its value? And let's say that I'm that guy who I'm 60, which I'm not, but let's say I'm 60 and I haven't accumulated enough money to retire and walk away from my business. But I've figured out how to increase the profitability of that business dramatically. So for the next 10 years, I keep growing the business and socking away more money. And at 70, I can now maintain the same standard of living that I have today throughout my entire life. Would you like to have that? Or would you like to have $75,000 in retirement income? Can't promise that we're going to be able to do that. No promises, no guarantees. It's the thinking that you have to continually do over and over and over and over again. This is not something that you do one time and put it in a drawer and say that we're ready to go. This is something that you have to be out in front. You just paid your taxes. Maybe you're on extension. You're not going to pay them till October. And you haven't done any freaking planning for this year. And you're going to be in the same freaking boat as you were last year. Pissed off that you're paying more taxes. I haven't met anybody. I mean, I love writing a check for a lot of taxes because that means I was very successful in my business, but I still want that check to be the least amount possible, right? And I find great energy and enjoyment in paying the least amount, right? It's great, but I also have great energy and enjoyment in doing that. And so you start thinking about your payroll. I'm just going to deviate back for a second because I want to go back to something. You've got 8 people on staff and it's $600,000 worth of checks going out the door in salaries. Think about each of those people that you're writing that check to. Are they getting the optimized value of what they're worth? Are they overpaid? Or are they underpaid? And what if when you take those 8 people and you go through and you're like, star, mediocre, slug. And that's how your business is performing. And that's why it's not quality. What if I could take that same $800,000 of payroll and get star? And it's hard to find employees. It's impossible to find employees. We've all heard that shit. That's bullshit. There's people out there that want to be part of what you do. All right. The same 800,000 with a star, with a bunch of stars, or maybe you don't need 8 people, you need 4, and they still get paid 800,000, and you get 3 times the work. Or you take some technology and bring it in and replace those people, and the technology and 4 people gets you an exponential output. You got to think out of the box. My goal today was to get you thinking outside of the box. My goal today was to raise your hand, subscribe to what we do, come on our website, do a wealth curve conversation. It's free, no obligation. If you're a business owner, when you go fill the form, mark, I'm a business owner. And right now you're going to be getting me to talk to. And if you don't get me, I'm going to get brought into the case because I love working with business owners. That is who we like to do this with. We love our corporate executives. We love our retired people. But the business owners are so much fun because of all the metrics that are in your plan. That's where you can make a difference, right? It's so freaking cool. So thank you for listening. Share this, forward this, comment on it. Good, bad, ugly, who cares? Just give me comments. Just give me feedback. Love you guys. Talk to you soon.